And so today, what we are going to be talking about is some of the basics around income and how we treat that in VITA. And so, first, just to start, we need to go over what's going to be covered in these slides. And so, some of the things that are going to be covered is some common forms of income, some business income, capital gains and losses, retirement income, unemployment compensation, social security benefits, and other income. And in general, that's going to cover the types of income that we are going to see in VITA commonly. And while there may be some that don't get touched on in this lecture, this should easily cover 90-95% of cases. So you should be pretty good to go on your income knowledge after this. So what is not covered? So as I mentioned, every single type of income and many of the more specific details are not going to be covered in this lecture. And so basically what this means is that you need to refer back to publication 4012 when you are entering income in the tax software to determine the amount of taxable income. And the reason why for this is that it just simply is not practical in a video such as this to go over every single scenario and every single type of income, but it's here to give you the general tools that you can go and find more specific details yourself in publication 4012. So after this lecture, you should be able to do that. Getting into some of the basics around income, we're just going to start off by talking about some of the main concepts that are going to be important to keep in mind as we go through this lecture. So first, the number one concept to understand is what gross income means. And basically what gross income means is it's all income that is not exempt from tax, and income is only exempt from tax if it is explicitly stated that it is exempt. If it does not state explicitly that it will not be taxed, then it would be included in gross income and likely be subject to tax. And so within the context of taxable income, which is income that is subject to tax, there are two main classifications that we think about. The first one is earned income, and that is any income that is received for work. So these are your typical wages that you would receive at a job or whatnot, as opposed to unearned income, which is any income not earned from work. So an example of unearned income for most people would be if they sell stock, because unless they're a professional stockbroker, that is not their main job. It is something that they are doing on the side, and it's more of a passive income, not something that they are deliberately laboring at and working for. And this distinction is very important for certain topics, which we will cover later in detail, particularly such as the earned income credit. And so just to start off here, I would say the most critical kind of income that we see and the income that comes up most commonly are wages, salaries, and tips. And so this type of income is typically obtained by performing work, as we probably all know. And an important thing here is that it is generally reported on Form W-2 and is generally classified as taxable earned income, which means that it will be subject to tax. And importantly here, all of that's very straightforward, but there are times when the taxpayer does not receive the Form W-2 from their employer as they were supposed to. If this is the case, if the taxpayer does not receive a W-2 by January 31st, they should contact the employer, and if they have not received one still by February 15th, they should contact the IRS. And so occasionally we will see one of those scenarios where someone should have a Form W-2 and they do not have them. And so those are the steps that we should instruct them that they need to take if that is the scenario. And then a last note here on these, because in general, this type of income is pretty straightforward. I mean, for the most part, whatever you get paid in wages is subject to tax. But it's important to pay attention to the box codes on Form W-2, and there's a little key for them in publication 4012 that we will talk about later that can be used to decipher what those codes mean and whether or not they are in fact significant. And if there is a code, you should always enter that into TaxSlayer if it gives you that opportunity. And so just to look at an example of a W-2 here, and this is from 2014, but the form has stayed mostly the same over time. You can see here, for example, you're going to have information over here on the employer's name, their employer identification number. You're going to see the employee's social security number. You're going to see information such as their first name and initial here for the employee. And then in these boxes are where you're actually going to get all of the numbers that you need to enter into TaxSlayer when you go ahead and enter that W-2 as income. So you see here, we got their wages, tips, and other compensation. We get their income tax withheld on that. Social Security wages, their Social Security tax withheld. Medicare wages and tips, their Medicare tax withheld. So again, you see here, which I talked about, you have some letters in these box codes here. So if you were preparing this return, it would be important that you go and figure out what code D, for example, is here in this box 12 box code and figure out whether or not that is important for you. And publication 4012 has instructions on how to do that. And then here on the bottom, you'll see information related to the state and some of their state taxes, which will be important at the end when we talk about, or at the very end of these lectures when we talk about what we actually do with the state portion of returns. And so moving on here and diving in a little more specifically, something that we need to talk about here is tip income, because this is one that can easily be missed. And as a general principle here, and something that should always be followed, is that tips should always be recorded as income. And it's really important that we ask the taxpayer about tips if they have a job that normally receives tips. So for example, if you're preparing a return for someone and their occupation is as a server, you should probably ask them if they have any tips that are not reported on their W-2. And importantly, non-cash tips are also taxable income. So just because someone gives you a tip in something other than cash does not mean it is in fact exempt from tax. It will be subject to tax, much in the same way that cash income would be. So again, just keep in mind here, clarify with the taxpayer about tips, and it will always be taxable income. So the next topic that we need to talk about is scholarships and fellowships. And this is one that is particularly important for us here at the UO Vita, because obviously we serve many students who receive scholarships and fellowships. An important thing to note here is that there is some nuance around this topic, as there isn't really a straightforward answer as to whether or not scholarships are going to be taxable that's applicable to all cases, because they may be fully, partially, or not taxable at all. And they are not taxable income, and this is the rule that you need to remember when you're thinking about the amount that's taxable, is that they are not taxable income to the extent that they are used for qualified education expenses. And so some examples of qualified education expenses are tuition, books, and supplies. But an important note here is that room and board is not considered to be a qualified education expense. And the basic principle around this here, and the way that I remember this concept, is if only a student could benefit from it, it counts as a qualified education expense. So for example, if you walked up to a random person on the street and tried to give them the books and supplies for one of your classes, that would be of absolutely no use to them. But something like room and board, that is housing and food, if you walked up to the random person on the street, that is something that would be very useful for them. So that's the way I think about it is, qualified education expenses are only useful for students, and that is why room and board is not included as a qualified education expense. And so again, just to drive this home one more time, scholarships and fellowships are not taxable to the extent that they are used to pay for qualified education expenses. So I'll walk through a bit of an example now. And so say we have a student here that received a scholarship for $20,000, and their tuition cost that they paid was $12,000, the cost of their books was $3,000, the cost of their supplies was $4,000, and the cost of their room and board was $8,000. So this would give us a total qualified education expenses amount of $19,000, because we add the tuition here with the books and the supplies, that gives us $19,000. And we do not add the room and board again, because that is something that the average person could benefit from and not just a student. And so then we subtract this qualified education expenses amount from the scholarship amount here, and that gives us a taxable income of $1,000 on that scholarship. So this would be a scenario where the scholarship would be partially taxable. And it's very rare that you're going to see a scholarship that's fully taxable. Most often it's going to be partially or not taxable at all. So for example here, if we altered this example a bit and this scholarship amount was $15,000, there would be no taxable income, because the entire scholarship would have gone to paying these expenses. And so the form that we're going to see scholarship related information reported on most often is Form 1098-T. So you see here, you're going to see payments received for qualified tuition and related expenses, and then you're going to see their scholarships as well down here. But it's also important to note that not all of the costs that qualify as qualified education expenses will be reported on this form, and so it's important during your interview with the taxpayer to get a better understanding of what they paid for items such as supplies or their books that are often not going to be reported on a form such as this. But this is the form. You're going to see a ton of them this year, and so it's important to get comfortable with it. And as long as you pay attention to what this is here, what this is up here, and pay attention to some of these items that may be checked down here, it is going to not be too bad for you, but it's something that is really important for us to touch on and do accurately. And so moving on to our next stage of income, I know it's going to feel like a bit of a string of me just talking about the basics of each kind of an income, and that's pretty much what this is. We're just going to keep moving down the line here, going through each type of income that we generally see. And so for interest income, it's most often going to be reported on Form 1099-I and T. And most interest income is going to be subject to tax, but there are some exceptions. And so when we're talking about interest income also, it's important to talk about what we mean. This could be anything from interest on a savings account that you hold at the bank or interest on something such as a bond. And we're talking about types of interest that may not be subject to tax. Generally, interest on a non-federal government bond is an example of something that may possibly, not always, be exempt from tax. So if you see something like that, it's important to go to the 4012 and look up and see what you are supposed to do with it. And also related to interest income, interest on a Roth IRA, which we'll talk about a little bit more later in this lecture, is generally not taxable, but this is not always the case. So again, let publication 4012 guide you if you see that there is interest on a Roth IRA. That's something you definitely want to consult your materials for, as you should really everything that you're doing. And so looking here at a 1099-INT, and this is a portion of this lecture, as you can probably tell, we're going to be looking at a lot of these documents here and just hopefully getting more comfortable with them. So you see here, we've got interest income reported here. We've got a withdrawal penalty. We've got interest on savings bonds, some investment expenses, federal income tax withheld, and a whole bunch of other items here that you're going to need to enter into TaxSlayer to have the return prepared accurately. And it's important as well that all this information matches and that's what you think it should be, and that all of these numbers are entered correctly into TaxSlayer as well. And so dividend income, this one is pretty straightforward. It's going to typically be reported on Form 1099-DIV, and most often it's going to be considered taxable income. Occasionally, we can run into exceptions around this. So again, it's important to consult your materials. But in general, as a rule of thumb, dividend income, such as dividend that a company pays out to their shareholders, is going to be included as taxable income. And so again, looking at 1099-DIV here, it's going to tell us, for example, the types of the dividends and the amounts for them, such as total ordinary dividends or qualified dividends. Some of the investment expenses are, what some of the exempt interest dividends are, and some other information on taxes paid and different withholding amounts. So again, much in the same way as we talked about the last form, really important to enter this all incorrectly and to ensure that all of the information matches what it is supposed to match. But yeah, pretty straightforward here, 1099-DIV. It is really important though to make sure that it all gets entered correctly and that we have a good attention to detail when entering these forms into the software. And so alimony, getting into a few more of the more complicated items here with income, it's gonna ramp up a little bit here in complexity from the pretty straightforward ones that we've already been talking about. So we're going to start off here with alimony. So what alimony is, and I think it's important to cover what it is because I know, at least personally, I didn't really know what alimony was before I started doing VITA or taking the tax class with Professor Krull. But what alimony is it is a legal obligation for one former spouse to support another former spouse financially. And importantly, the amounts that are included in alimony does not include child support. And so if the divorce agreement, and this is going to be an important theme here, it's about when the divorce agreement was executed. If the agreement was executed before 1985, we need to refer them to a professional tax preparer. We cannot prepare the return for a divorce that was executed in 1984, for example. And then importantly here, and this is where the bit of complexity around alimony comes from, is that the tax treatment depends on whether the divorce was executed before 2019 or if it was executed after 2018. And so the way that we treat alimony with regard to taxes for divorces that were executed before 2019 is that the person receiving the alimony has to include it as income, and the person paying the alimony can subtract the payment as an adjustment to income. And so again here, if a divorce is executed before 2019, it's income for the person receiving it, and it can be subtracted as an adjustment to income for the person who is paying it. Now contrast that to divorces after 2018. So this is, for example, 2019, 2020, 2021. If the divorce was executed in any of those years, the person receiving the alimony does not have to include it as income. And going along with this, the person who is paying the income cannot subtract it as an adjustment to income. So again, just to refresh and contrast them, this is really opposite of what it was in the last scenario that we're talking about, where it was included as taxable income and it could be subtracted as an adjustment to income. In this case, we're talking about years 2019, 2020, 2021. The person who is receiving the alimony does not have to include it as income, and the person paying the income cannot subtract it as an adjustment to income. And so moving forward here, we're going to take a look at some business income. And we don't generally see a ton of business income at our site. We'll see it every now and then, but usually nothing too overly complicated. But there's still some important details that we have to talk about. So business income is most commonly reported on the following sources: Form 1099-NEC, Form 1099-MISC, Form W-2, and Form 1099-K. And importantly here, if a taxpayer has income from cryptocurrency, we need to refer them to a professional tax preparer. And I'm guessing that's something that we may see come up this year, especially as cryptocurrency has become more popular, especially since the start of the pandemic. So that's something that we are going to have to be vigilant for. An important note here is that they have to include all business income, even cash payments. So this goes along with a little bit we were talking about with regard to tip income, where even if you get paid in cash and it's not on a form, it still has to be included as income. And a little note here at the end, it's something that I've never personally encountered, but they talk a lot about it in the IRS training materials. So it's an important thing to note here is that you need to be on the lookout for abnormal situations, such as Medicaid waiver payments that may require special treatment with regard to business income. If you see Medicaid waiver payments come up, A, consult your resources, and B, consult a more experienced volunteer because they can get a bit tricky. And so how is business income typically reported? So typically it gets reported on what's called a Schedule C, and there's not much that we have to do in the tax software really for this. It will generate itself, and you'll be able to see that on the tutorial when we walk through that eventually. And we can prepare the Schedule C with the advanced certification for volunteers, subject to certain limitations. And so that's one of the important reasons why we try to make sure that everyone gets that advanced certification, is so that we can prepare Schedule Cs. And so we can't prepare all types of business income, as you would imagine, considering that could get very complicated. And so it's important to talk about what is actually in scope for VITA. So volunteers can assist taxpayers who have returns that require Schedule C within certain limits. For example, they need to have less than $35,000 in business expenses. They need to use the cash method of accounting. They cannot have any inventory at any time during the year. And they did not have a net loss from the business. They have no employees during the year and did not pay contract labor for services. They are not required to file Form 4562 depreciation and amortization for this business, and they do not deduct expenses for business use of a home. So as you can see there are a lot of limitations around business income, and that's probably one of the reasons why we don't typically see a ton of it. But if you are preparing a return where they do have business income, I would refer to this list, and I would make sure that they do not have any of these items that would make the return be out of scope for VITA. And so business expenses here, and we probably all have a decent understanding of what this means, but business owners are allowed to deduct business expenses that are necessary and proper for their business. So this will fluctuate depending on the industry that the taxpayer is in, and we can generally take their word for it that the expense is necessary and proper unless it's something absolutely egregious that we know is not necessary and proper. And so what are some common expenses that we will see business owners try to subtract from their business income? So for example, we'll often see advertising, we'll see supplies, and we'll see repairs and maintenance. Then also here, and this is a bit of a wink for the exam, the advanced exam, is car and truck expenses. I'm probably going to make a separate video covering some topics that may be useful for you for the advanced exam that are not always the most relevant as far as preparing accurate returns at our site in particular. This may be one that ends up in there, and it's important to know that for car and truck expenses, we use standard mileage, and then you can study this in publication 4012. In that, I think that is something that you're going to want to study for the advanced exam in particular. And so moving on from business income there, and just to further drive home business income, really the thing that you need to be doing there is making sure that you calculate the total amount of income they have correctly, enter it into TaxSlayer accurately, which there are instructions for in publication 4012, and then add up their expenses accurately, and that should give you the business income that we can report on Schedule C. And so capital gains and losses is going to be our next topic, and generally this comes from when an asset is disposed of or it is sold. And the taxpayer will almost always recognize some kind of gain or loss on the transaction because it's very rare that something is being disposed of at exactly break-even price. And so we can't do all kinds of capital gains transactions, but there are some that we can do. And so the three that we mainly can do are the sale of stock, transactions involving mutual funds, and the sale of a personal residence. And each of those will get treated a little differently, but in general, they follow many of the same principles. And so there's some information that you need to know to identify what the gain or loss is on a capital gains transaction or loss transaction. So the first thing you need to know is the basis in the asset. And so it's kind of a concept that can be a little difficult to understand if you don't know what it means already from a prior class. But basically, the basis is the value of an asset that is used to determine the gain or loss, and most often it's going to be the cost of the asset. So for example, if you bought a share of stock for $100, your basis in that asset is going to be $100, most likely. And so the second main piece of information that we need to know to identify the gain or loss is the holding period. And really we need to know from that is when the asset was purchased. And the reason we need to know when the asset was purchased is that if it has been owned for over a year when it is disposed of, it is a long-term gain or loss. Otherwise, it is a short-term gain or loss. And then we need to know the proceeds from the sale or disposition, which basically means just the monetary amount of consideration that we received in return. So basically the price that we received for getting rid of that asset. Put those three together and that can tell us whether it's a gain or a loss and what kind of a gain or loss it is. And so for example here, we're going to take a look at an asset that was purchased in 2016 for $1,000 and it was sold in 2021 for $3,000. And so the question is, what is the capital gain or loss and how would we classify it? And so going through some of the steps here, we look at how this be calculated. So our basis in the asset would be $1,000, and that's because that is the price that we paid for it. Our holding period would probably be about 5 years. We don't really know in this example when it was bought within the year, but we'll just say 5 years for simplicity's sake. And our proceeds from the sale was $3,000 because that's how much we received for selling it. And so we would get a long-term capital gain of $2,000 because we would take these proceeds from the sale, subtract the basis, That gives us $2,000. We see that the holding period is greater than 1 year, and so that gives us a long-term capital gain of $2,000. And so now if we flip around some of the details in this example, and it might have been hard to tell there, but these numbers did change slightly here. We're going to say that the asset was purchased in 2016 for $3,000 and it was sold in 2021 for $1,000. And so what is the capital gain or loss and how is it classified? And so again, going through the steps here, the basis in the asset is going to be $3,000. The holding period will be 5 years again. That is unchanged. But the proceeds from the sale, just like the basis changed, will also change, and the proceeds were only $1,000. And so the holding period here stays constant, so our classification as long-term stays the same, but we have a loss here now because if we subtract $3,000 from $1,000, we get negative $2,000. So what that means is we have a long-term capital loss of $2,000. So capital gains and losses, they can be very scary, but at a fundamental level, really, if you know the basis, the holding periods, the proceeds from the sale, you can do a pretty good calculation of the gain or the loss, and TaxSlayer will help you with this as well. And so a layer of complexity here that we also need to be aware of, we won't often see this, we'll very rarely, if ever, see this, is carryover capital losses. And so the taxpayer can only deduct $3,000 in excess capital losses each year. And what that means in excess capital losses is that it's your amount of capital losses over your capital gains. So, for example, say that you had $10,000 in capital losses and you had $7,000 in capital gains. That would mean you have $3,000 in excess net capital losses for the year. And so since they can only deduct $3,000 of excess capital losses each year, the remainder that they cannot deduct that year can be carried forward indefinitely into the future to help offset future income. So for example here, if a taxpayer has a net capital loss of $10,000 this year, they can deduct $3,000 this year and carry forward $7,000 to future years. It's also important to note that this word here, net capital loss, illustrates that this is not the total amount of capital losses. Rather, this is what is left over after capital gains and losses are netted together. They got a net capital loss here of $10,000. So again, they can deduct $3,000 of that this year and they would carry forward the $7,000 to future years. And so getting specific here, and where we see a little bit of a difference in how some capital gains and losses are treated, is the sale of a personal residence. So taxpayers may be able to, not always, it's a may, definitely use the instructions and resources in TaxSlayer and the different resources that we have. Taxpayers may be able to exclude up to $250,000 in gain on the sale of a personal residence from income. So that's really great there. But on the other end of the spectrum, a loss on the sale of a personal residence cannot be deducted because obviously they're letting us exclude some from income there. They're not going to want to let you deduct that on the other side as well to get that double benefit there. An important note is that selling expenses decrease the amount of gain on the sale of a personal residence. And so if you calculate the gain or the loss on a sale, you have to make sure that you factor in selling expenses and subtract those from the amount of the gain if there is in fact one. Again, I would instruct you to consult publication 4012 when you are entering the sale of a home because there are some specific instructions in there that you can find. And this isn't something that we see come up very often, but it is occasionally something that we will in fact run into. And so moving on to one of the last clumps of income here in this lecture is we're going to talk about retirement income. And retirement income can include a lot of different things, but some of the main ones that we will see are Social Security benefits, benefits from annuities, retirement or profit sharing plans, insurance contracts, IRAs, and many other different sources of retirement income. And generally, they're going to be fully or partially taxable. In most cases, some cases it's not going to be taxable, but in most of the time it will be fully or partially taxable. And so what are some of the forms most often used for retirement income? So as you can see there, we have a lot of variations on the screen of 1099-R. So basically what you're looking for when it comes to retirement income are 1099-R forms. An important note here when you look at a 1099-R form is that when the taxable amount is not shown on the form, we use the simplified method to calculate the taxable amount. We'll talk about that a little bit in the lecture, but there's some instructions, publication 412, on how to do it. And really, TaxSlayer does most of the work for us. And so I would not worry too much about the calculation of the simplified method, but we'll go over a brief overview of it for the sake of completeness. And so an important thing to talk about with regard to retirement income is some of the general concepts, because these really serve as the guiding principle for how we think about the taxation of retirement income. And so the first thing is how plans are funded. And so first thing is that plans are funded with either before tax or after tax contributions. And so it's an important thing to get in your head is that you need to start looking at a contribution to a retirement account as either a before tax contribution or an after tax contribution. It needs to fall into one of those buckets. And so now let's explain what those two different buckets / categories are. So before tax contribution is where the employee did not pay taxes on the funds contributed to the plan, which means that they have no basis in the plan. Basis is being used here similarly to how we talked about with regard to capital gains. So again, before tax means the employee did not pay taxes on the funds that were contributed to that retirement account. If it's after tax contributions to the retirement account, that means that the employee did in fact pay taxes on the funds that were contributed to the plan, which means that the employee does in fact have a basis in the plan. So again, after tax contributions means that the employee did pay tax on it already, as opposed to before tax where they had not paid tax on it prior to it being contributed to the plan. And so the portion of the distribution from a retirement account that represents a gain above the basis, which comes from those after-tax contributions, is the amount that will in fact be taxable. And so again, if that's not quite clear right now, I would not stress out about it too much. In reality, it's just important to understand the general concepts there and really enter the numbers correctly into the software, as that will often give you the result you need when preparing the return. And so one of the important concepts with regard to retirement income is IRA income. And so what an IRA is an IRA is an individual retirement account that is a savings account with tax advantages that individuals can use to save and invest in the long term. And distributions from these accounts are reported on 1099-R. I know, real shocker there after the list we provided on the last slide. And earning and investment gains in an IRA generally accumulate tax-free until there is a distribution from the account. So what this means is when you're going to start paying taxes on an IRA in general is when it is actually distributed from the account. And so there are 4 different types of IRAs that we will see here in VITA. So the first one is a traditional IRA. The second one is a Roth IRA. The third one is what's abbreviated to being called a simple IRA. And the fourth one is what's abbreviated to being a SEP IRA. So for a traditional IRA, in general, the distributions are going to be fully taxable unless non-deductible contributions were made by the person contributing to the plan. And if they made non-deductible contributions, they need to be referred to a professional preparer. So in general, for our case, it's going to be fully taxable in pretty much every single case. Otherwise, they need to be referred to a professional preparer. And so for a Roth IRA, qualified distributions from a Roth IRA are tax-free and they can be excluded from income. So you notice here that's a little different than from a traditional IRA. And you'll know that's a qualified distribution oftentimes because code Q will be in box 7 of form 1099-R. So that's where I've talked about with a lot of these different forms. The box codes are important and I would refer back to them anytime that you see one on any form because they can give you helpful clues, such as on box 7 of form 1099-R. When it has code Q in it, it's qualified distribution. And now moving on to the simple IRA. So some employers offer their employees the chance to contribute part of their pay to an IRA as part of a simple plan. In general, these distributions are fully taxable since before tax contributions are made to the plan. So in general, since the before tax contributions are made to a simple IRA, it's going to be fully taxable. And now finishing off here with the SEP IRA, really they're taxed pretty similarly to how simple IRAs are. So again, it's going to generally be fully taxable since before tax contributions are made. And so moving forward here, as we just keep churning through these different kinds of income, we're going to look at pensions and annuities. And so these follow many of the same rules that we have already discussed. And in general, distributions from a pension or annuity account will be fully taxable if the taxpayer did not pay any part of the cost of their pensions or annuities, employers did not withhold part of the cost of their pensions or annuities, employers withheld part of the cost from the taxpayers before tax pay while they worked. So in general, if it meets any of those criteria, it's going to be fully taxable. And so looking at partially taxable pensions and annuities, there are two methods to determine the taxable portion of a pension or an annuity, the general rule or the simplified method. So we use the simplified method here at Vita, and if they've been using the general rule in the past, we need to refer them to a professional preparer because we cannot prepare the return in that case then. And so, as I talked about earlier, TaxSlayer is going to do the math for you on how to calculate the taxable amount under the simplified method, but there is a specific formula and sort of how it works that may be helpful to be aware of. And so the simplified method worksheet calculates the taxpayer's cost basis for each monthly payment. And again, I would refer back to publication 412 because there are specific instructions in there that talk about how, in fact, you need to fill out the form in TaxSlayer in order to have the simplified method calculate accurately. And so really the simplified method is in order to calculate the monthly tax-free portion, it takes the taxpayer's cost basis and it divides it by the number of monthly payments. And the taxpayer's cost basis is the employee contribution that is reported on Form 1099-R. And so you can basically think really what the simplified method is doing is it's taking that cost basis, dividing it by the number of monthly payments to get the monthly amount that should be free from tax. And then it takes the total amount, subtracts that tax-free portion, and then that gives us the amount subject to tax. And so moving on here, take a look at 1099-R, and this one isn't filled in here, but as you can see looking at it, there's a lot of different things that are shown on this form. It's really important here, as we talked about already, pay attention to the distribution codes, pay attention if this box is checked. Notice there, we talked about them, IRA, SEP, simple, IRAs. You pay attention to if that is checked. And you see here, you can find the distribution amount, the taxable amount that's already calculated. We hope that that is calculated because that makes our life easier. Then we don't have to do the simplified method. But if it's not, we do a simplified method. It's not too bad, but it's always nice when the taxable amount's calculated. Same as all the other forms. Make sure all this information agrees, and then nothing looks off to you. And so we're coming down the home stretch here with all these different forms of income, but disability and pension income. So before they reach the designated retirement age by the employer, disability and pension income is taxed as wages, and after that, they are taxed as retirement income. And so that can have some important differences there when we get into some of the more nuance around some of these topics around taxes. But really for us, what we need to know is that if they are younger than the designated retirement age by the employer that's paying them disability or pension income, it's going to get taxed as wages. If they are that age or older that the employer designates as the retirement age, it's going to be taxed as retirement income. And so some other retirement topics to be aware of that don't often come up but may occasionally come up is lump sum distributions. And I should know for all of these there are instructions on how to handle them in the resources that we provide. And so lump sum distributions, these are distributions of an entire account balance. So basically you're emptying out the entire retirement account. You're taking it all as one lump sum, as the name would infer. And so the second topic to be aware of is early distributions and a withdrawal penalty from a retirement fund by a taxpayer who is under the age of 59 and a half years old. So basically, if someone's under the age of 59 and a half and they're withdrawing early from a retirement fund, they may be subject to paying additional tax. And so it's important, again, to refer the resources if you think that there may be an early distribution occurring. The third one here is minimum distributions, and that's just for more of your understanding, is that often taxpayers must take a minimum distribution from their retirement plan every year. They are obligated to do that in many cases. And so unemployment compensation, and this is probably something that we're going to see this year with COVID, and in most cases, unemployment compensation is going to be considered taxable income. So it's pretty simple there. It's going to be considered taxable income. So Social Security benefits. So portions of the benefits may be taxable. Generally, if Social Security benefits are the only source of income for the taxpayer, it will not be subject to tax. And so the way that we can get a general sense on if a portion of it is going to be taxable is that a portion of the benefits is taxable if total income, including tax-exempt interest, so it's important you add that back if there is any of those, plus 50% of benefits received is more than certain base income amounts. Again, that's very vague. TaxSlayer is going to do the work for us though, so I would not worry about that amount. And to correctly calculate a taxable amount, you need to know the amount in box 5 of Form SSA-1099 or Form RRB-1099. That's a nice typo there. With the of, it's one of my trademark typos from these videos. There's always a couple of them, as you're probably realizing by now. And again, always be aware of the box codes. You'll sometimes see them pop up on those different forms, and they can say important things that you should refer back to publication 4012 for more information on. And so cancellation of debt, and I do believe this is our last form of income in these slides, and it is. Woohoo! So cancellation of debt. So generally, if the debt of a taxpayer is canceled, that means the bank just pretty much says, if, for example, if you owe money to a bank, the bank just says, okay, fine, you don't have to pay us. They're going to generally provide them a form with that. And generally, if the debt of a taxpayer is canceled, it has to be included in income. Now, this is not the case if someone, for example, pays off the debt for them. That is not considered to be a cancellation of debt. So those are two different things. And if the taxpayer was insolvent when the debt was canceled, the return is going to be out of scope. So if someone shows up and said that the bank canceled my debt this year, generally it's going to be included as income because they did receive something of value because their debt got canceled. But if the taxpayer was insolvent, we cannot prepare that return, and the return is out of scope. And so with that, we have made it through the general overview of some of the major types of income that we are most often going to see here at VITA. And I'm going to now take some time and walk you through publication 4012 a bit, tab D. It's going to be a bit of a more brief overview because you'll probably tell when I get in there, tab D is a beast of a tab, and it's something that is going to be very important for you to use. And so I would recommend that you study it on your own as well and go over it as well.